where we are going to be manufacturing 80% in India, focusing on Make in India. In the past, we were doing 20% in India and 80% imported. So that's a very significant impact.
Entrepreneur, all said and done. And then there is a misconception that it's very easy for the second generation or a third generation to build the business. But I think it's quite difficult because you have bigger shoes to fill.
Based on my past experience, people can make or break a company, and growth can only come when you have the right people at each. Now has a target to do 200 new ships over the next 15 to 20 years. So we see that as a very big future.
Hi everyone. Today we are in Mumbai with Lloyds Engineering Works. It's a 5,000 crore market cap company listed, and they are into capital goods. Capital goods are mostly going into oil and gas, nuclear, defense, and even other industries, other core industries that India is into, like power. And what they manufacture might sound complex, like pressure vessels, columns, and even steel blast furnace. So today, to break this down and to tell us the entire journey, how the company formed since 1954, they started operations, and then how they climbed the ladders and made it a big company, we have with us the promoter himself, Mr.Shree Krishna Gupta.
Hi, how are you doing?
Good, very well.
Thank you for coming down.
Firstly, I wanted to touch upon your journey because you're very young, and I would say you are the youngest promoter that we are interviewing. So how has been the journey, from education, and run us through till today?
I did my higher education in London. I did my high school or college there as well. And I studied university at Brunel, which is about an hour outside London, where I studied international business. I came back to India right after university. And my father, who started this company in 1974, it was his first venture and his first entrepreneurial journey. He told me that I should get into the family business, but before that, to start something of my own and understand how things are done in India, how you start a company, how you set up a company, hiring people, dealing with local issues, dealing with creating a company, compliances, customers, and various things. So we had a lot of brainstorming sessions, and we realized that there's one industry which we are passionate about, and we felt that there was a big niche in India, which is men's grooming. Okay. So when I studied in London, I used to go for a lot of relaxing and luxurious shaves, like a 45-minute shave, which was a great experience.
Turkish barbershops?
Turkish and British barber shops as well. And in India, there was nothing like that. It was either a mom and pop shop or a service in a 5-star hotel. The service was the same, just in a different setting at a higher price point. So we thought we should get an experience, and we did a collaboration, and we tied up with Truefit and Hill, which is the world's oldest barber shop, and they have a royal warrant, and they're great legacy, great brand history, amazing products, great service, great experience, great team. So we managed to get the franchise of the brand to India very fast. And we started that about 10 years ago. And that was my first entrepreneurial or my first work experience in India. And as of today, we are about 30 plus stores, locations across the country.
That company.
In Truefit and Hill, correct. So we do barber shops where we have all the men's grooming services as well as products. So the company has about 50 plus products in India from the UK, and we retail them through our stores and online. So the company is currently listed on the stock SME exchange, which is very unique for such a small size and in this industry. And it's given me a lot of experience in management, creating teams, processes, training, customer management, customer relationship, and various other things. So that was my first journey. After that, me and my dad have a passion for pizzas and food. So we also started another company for doing Italian pizzas, authentic Italian pizzas. So the brand name is 1441 Pizzeria, which is the longitude and latitude of Naples, the origin of the first wood-fired pizza in the world. And we do wood-fired pizzas, we do Italian pizzas, we import our flour from Italy, we import our tomatoes. So we have a really good quality and authentic pizza, but very Indianized to serve the Indian market. We have about 15 plus stores in Bombay mainly, and it's going well. But these were my two journeys before I got into the engineering business.
And then you got into the family business.
Correct.
And coming to that, it's not that you came in and you settled, but you actually increased the business by quite force. So I was checking your financials, and that's why we're doing this, right? Meaning we found your company interesting because of that reason. FY22 revenue is 50 crore. FY23 you increased it to 300 crores, like 6x jump. And now I think you're trailing at 600 crores if you would be closing in March 2020.
So I started working in the company in 2000.
So what changed? What was the trigger? Of course, industry was one, capital goods industry. Even if you see major players, Anup Engineering, Thermax, even they have grown. So what has been the trigger and what was your contribution?
So over the years, the company's gone through many ups and downs. We went through a management change as well. I started working in the company and joined in 2019. So for 2 years, I was understanding the business top to down, understanding complete engineering of the company, what the core is, who are customers, who are the stakeholders, what are the issues, and getting a feel about the entire company. We took back the management of the company in 2021, and so that was the first goal, so that we can grow and have the flexibility to do what we want, how we want, and that's really made a good impact. Another key focus was on the teams, improving the teams, creating a better working environment and creating a better management to be able to grow. People are at the core focus of what we do, and giving them the freedom and the tools to do best what they do has really resulted in a good performance change. Along with that, investment in Capex, investment in our manufacturing facilities, to grow our manufacturing facilities and really understand what our clients want, which was lacking, and to dive into new technologies, new collaborations, and some of the industries where we were when we started, and it was missed out over the years, to re-enter into those industries.
So you were functioning well below your potential before you came in because of the previous management. So I'm noticing 4 pillars here. Firstly, the management change. Secondly, people. Third, Capex. And then overall improved efficiency. Technological tie-ups, you say, but then has it spiked revenues yet, or is it a future kind of, future area? Because I'm saying, how did you go from 50 crores to 600 crores?
Right.
So that happened through, like, just in pointers, 3 pillars, what would it be?
So people,
Okay.
Capex,
Okay.
and
So on Capex, you say, were you operating below capacity utilization, below efficiency, right, when you came in?
right, we were operating at below capacity utilization. First, when we started in 2021, when we restarted in 2021, it took us a few months, but we got a lot of good orders, and that helped us fulfill our capacity at that stage. And we invested in the company to take over another unit, which was next to our factory, convert that for our requirements, as well as build another unit. So we doubled our work floor in about 2 years. And that helped us to build our top line in terms of actual output of equipment, as well as a few other industries which were stagnant over the years, which require a lot of site work and more engineering and more off-site or on-site work rather than factory work.
Okay. Because you said different industries, I want to ask the next question. Is you have changed the name thrice, and recently you changed from Lloyds Steel Industries to Lloyd Engineering Works as it is today. Why the change, firstly? And secondly, were you only catering to the steel industry previously?
So when the company started, it was Lloyds Steel. And over the years, they also added a steel manufacturing facility. And through the ups and downs and the change of hands, currently, when we took it over, we were only the engineering works facility where we manufacture heavy engineering products.
Okay.
So we don't have anything to do with manufacturing of steel or trading of steel. We're an engineering company at heart, and we're a manufacturing company at heart. So works is usually a manufacturing works, and engineering is what we focus at. So we thought it's more fitting for the name and more fitting for what we do. And we wanted to recreate the identity and move away from the past issues and focus on the future. And this was a great way to do that, and important in all the changes that we were doing.
Absolutely right. You don't do steel trading and all these things, but can I break it down the entire value chain? And correct me if I'm wrong.
Correct.
Okay, there'll be areas you can help with. So let's say India is growing at 8%, 7%, whatever it may be. So India is growing. So construction industry, cement, steel, you need road infra. For example, recently one of your competitors, Concor, they said in the next 25 years, India has to create 3 another Indias. So obviously that would require a lot of capex. The government is also focused towards capex, defense, whatever it may be. And this then, and these steel players, whether it's Tata Steel, a lot of other players, Jindal, they are thinking of doubling, tripling the capacity. Whether it's even cement players. So you provide equipment that can be used by the Tata Steel and other players. I'm just giving you just a generic area, generic names. You provide these equipments, right?
Correct.
That
so
is used.
A little history into what we were doing, what we started doing in 2021, and what we currently are doing. So since the company started, we were into various fields. So from in the 70s, 80s and 90s, where we have done steel plant equipment, we've done power plant equipment, we've done hydrocarbon equipment, we've done heat exchangers, and we've done Navy and marine equipment.
Okay.
So hydrocarbon is something that has been consistent since the beginning to now, which has been a bulk of the 50 to 60 crores in the last 10 years every year. Steel plant equipment was stagnant in the middle because of investment, manpower, and various other reasons of the past management. Power plant, which includes boilers, was a very big part in the early phase of the company. In the middle, again, it was something that was missed out on. Power plants and boilers require a very big management team, a very big design process,
There's science
operations.
behind it.
There's a lot of calculations, a lot of technology, a lot of designs, proprietary designs, which require manpower and require a lot of investment. So that was, again, something which was very stagnant in the middle. Marine and naval equipment as well. We focused on marine loading arms, which offloads and loads fuels and gases from the ships to the ports.
Okay.
So at all ports, you will see marine loading arms, and we used to supply that, and we still manufacture that. And we had a collaboration with another company in the past. In the middle, there were a lot of issues, and the collaboration broke off. So that's something which we've reignited with a new collaboration. So sticking to marine loading arms, currently we've done a collaboration with a Japanese company where we are going to be manufacturing 80% in India, focusing on Make in India. In the past, we were doing 20% in India and 80% imported. So that's a very significant impact.
You're doing this 80% using the Japanese technology?
Using that technology. So we will use their technology and designs, manufacture 80% of the components in India, 20% of the critical components will be done in Japan.
Okay.
And the concept with them is that in the future, we will also develop our manufacturing to manufacture those 20% in India. And if things go well, export for them to the rest of the world. So that is a very big part in the future to building a better business, because Make in India is a priority. That will help us to get better margins as well.
Aligning with the government, right?
And aligning with the
Government's
government.
vision.
So that's on the marine loading arms front. Navy is a very big part.
Is that part of the defense?
It's part of the defense initiatives. And for us, Navy, we were focused on a few key items which are very critical components to ships, which are the steering gear systems and the stabilizers. So it's a very critical components. And before 2010, we've supplied multiple ships. From 2010 till now, we've not supplied any ships. One key factor is that there have not been too many ships in production and manufactured within India. So there's no business on those lines.
Sorry, ships.
Navy ships, so with the shipyards or with the Navy, there's not been too many introduction of new ships.
Okay.
But the government now has a target to do 200 new ships over the next 15 to 20 years.
Okay.
So we see that as a very big future prospect.
Okay.
We are currently applying for a couple of tenders for a few ships, and that should be a significant portion.
There should be a start.
Exactly.
Restart,
that should be a significant restart.
And you said hydrocarbon, right?
Correct.
That is oil and gas.
Oil
in
and
simple
gas
terms.
industry.
Okay.
So the oil and gas industry is growing 5 to 7% every year. But that 5 to 7% is a very large Capex value, which might be more than 1 lakh crore of Capex every year.
Okay.
So there's a very significant chunk going to large EPC contractors who we get our business from. And we are growing within that to work with them and to work with EIL, who is Engineers India Limited.
So just to interrupt there, so let's say ONGC, they're doing oil refining, let's
Correct.
say. They give a contract to the EPC.
Correct. So they
EPC
will give a
company.
large contract of 5,000 crores to one EPC contractor, and they will give us a contract for 15 equipments
Got it.
in different processing tools of oil and gas. So one type of material will flow in from the top, and the equipment that we manufacture will process that product and give multiple byproducts or different processes what is required by the customer.
Got it. No, oil and gas is very interesting. People think it's a very mundane and boring industry, especially when EV is on the rise. But oil refining is what the government is focused on, and even companies are going full throttle with it. So current refining capacity in India is 5 million barrels per day. And that is very minute compared to the demand or what the future demand would be. Future demand is whatever energy consumption growth we'll see until 2045 in the world, 28% contribution is from India. So major part of that energy consumption growth is because of India.
Correct.
And government is saying that we will do 1 million barrels per day increase in refining capacity per year.
Correct.
So 1 MBD, million barrels per day, every year until 2028. So from 5 million, it can easily double in 2029, 2020, 2030. So what is I want to come back to the previous point you mentioned. What is the value of a simple, like one machine, the most basic machine that goes into the oil and gas industry? What is the value of each?
It's different kinds of equipments. We manufacture mainly columns and vessels, which are used in the processing. So depending on the size, it can go from 50 lakhs to 5 crores, maybe more, depending on the size and the requirement and the material used. And each order can consist of 1 or 20 of each of these equipments. So for us, an order could be a 50 lakh order or a 15 crores order or maybe more, depending on the tenders floated.
Does the EPC project contractors release the tenders?
Correct.
Or do they have a pre-existing relationship with you, so they give you the order? How does it work?
So it's multifold. Whether if it's an EIL, which is a government organization, they will release all tenders online. If we qualify based on different criteria, we qualify for the bids and we take part of the bids. With other companies, we reach out to them as regular marketing activities and see what contracts are available. Once we manufacture enough of these equipments, they reach out to us and let us know that these are the tenders coming up. So to be part of it or not, depending again on our past track record or current specifications, if we can or cannot manufacture it.
Got it. It's a very blunt question, but is it the cheapest wins all?
It is.
Okay.
After being qualified technically, it is the cheapest wins all.
Now, because you said government tenders, towards the end of the financial year, because the coffers, they want to exhaust the coffers, the budget that was allocated to different industries. You see a huge spike in orders during the last quarter. Is your industry also something where you see a spike in revenues or order book during the last quarter?
Not really. These are all made-to-order equipments. So it depends on the project and the status of the project, where they are. And again, since they're made-to-order equipments, there's nothing being compiled till one point, and they're all very process-specific equipment. So if the end customer requires the equipment for a certain process, he requires the equipment for a certain process.
That doesn't matter what time of the month.
It's their timeline of the end user based on the process. It's not a budget timeline. It's the requirement.
Got it. And how much time does it take you to manufacture one unit? Let's say pressure vessel.
Correct.
How much time does it take you
About
to?
10 to 12 months.
10 to 12 months, one single unit.
One order.
One order.
Yeah. So our manufacturing timelines are usually 5 to 7 months, depending on the size. Our designing is a couple of months on the higher side, and our material sourcing post-designing is again a couple of months, depending on the material and the quantity. Larger quantities, we go usually to the mills directly if we can, otherwise depending on what's available. And once the manufacturing is complete, testing, getting approvals, etc., and dispatching it and reaching the customer takes about a month or so.
Does any rejection happen in this industry because you're putting so much, you're front loading so much of work? That's first question, if rejection happens. Secondly, do they give you advance and then you execute the project? Because in infra, everyone knows how it's done, EPC, HAM, BOT, the other styles. But in capital goods, you work, because of government, there is a push towards industries. So how does the payment cycle work, if you can explain?
Sure. So rejections, there are rejections in the industry, and we do see a few percent rejection within other companies. For us, we're close to 0% rejection. So we really focus on quality. We focus on getting our engineering sorted out in the beginning to the best level. And during manufacturing, we have a lot of different stages of quality inspections, quality assurances, quality control, and our focus is on good quality, and we don't have any rejections, if at all. On the payment cycle, we usually get an advance 5 to 10% depending on the contract, and maybe a 5 to 10% on certain criteria, which is material being received. Other than that, we get the balance or the bulk of the payment when we do delivery. So that's usually how it works. So when we...
What percentage?
About 80%.
80%. So companies that face rejection would be bleeding at 80%.
That's right.
The order value.
That's right. And along with that, usually blacklisting happens where they don't get accepted for future tenders. So again, when I said earlier, getting qualified for a tender, it's technical qualification as well as past track record. So if you've done the job and if you've done the job to a good specification, you get qualified.
And in infra, for example, if there is, let's say, 20,000 crore project, they will divide into 4 or 5 and give it like 4,000, 5,000 crore project to 5 different parties. So does that happen in your area?
Definitely. So we get, there might be an end customer who requires multiple equipments, but we might get tenders from 2 or 3 different customers who are working at different sites in that one project. So we do get tenders from multiple people for the end customer as well.
Okay. And what is the life cycle of one product? Because look, firstly is pure industry growth, that the industry is growing, so new number of products you will have to supply. Okay. But then at the same time, it's like airlines business. You need new aircrafts, but at the same time, you need to replenish, you need to service the old aircrafts as well. So
it's about 20 years,
life cycle of one product.
Of the life cycle.
Okay, great. Now coming to the core industries that you supply to, you said hydrocarbon, that is oil and gas in simple terms. And if refining capacity is increasing by, let's say, 2x, even your ideally, even your demand should increase by 2x. And if you're doing better than the competitors, it should be 2.5, 3x.
Definitely.
Okay. First. Second, nuclear is an interesting sector, but India's push is very low. For example, the energy if we're consuming 100 gigawatts of energy, for example, we're consuming 240 gigawatts, but let's say 100 gigawatts if you're consuming, only 3% or 2% comes from nuclear. In France, it is 70%. So do you see this? And we did a study on windmill versus solar versus nuclear versus coal. Even if you count the upfronting of the carbon emissions during like different, like solar panel, you require this much emissions to manufacture that voltaic cells, silicon, etc. Windmills, concrete, steel, that's required. But nuclear comes out to be the cheapest in terms of CO2 emissions, front loading and throughout the life.
Right.
So do you think nuclear is an upcoming industry at all in India?
Definitely it is. So when I started, I met all our stakeholders, which includes our suppliers and our customers. We met the senior team at NPCIL and at BARC as well, and understood that they have a lot of new projects coming up. They're very bullish in this segment, and they will have a lot of opportunities for growth because it's a very key part of the government's initiative to boost the nuclear power and to boost this industry. That will give us a lot of options to cater for this industry because there are very few manufacturers within this industry who are approved by the NPCIL or by the BARC. And that is a segment which we feel we can definitely capitalize in the future.
But that'll be a completely new segment, like you said, because it requires a lot of science, a lot of maths. Because at the end, you're dealing with thorium or let's say,
Correct.
What is the other element? Uranium.
Uranium.
And then you're, because of fission, you're heating up and then the water, steam, turbine,
No, definitely.
etc.
But I feel that they focus a lot on design and quality, and they focus a lot on the core specifications of the equipments. And unless you're qualified with them, it's impossible to do anything for the nuclear industry. So luckily we've got a good past track record and we've got good relationships with them. So we should look at a positive future.
But nuclear, if I take your order book, will be zero, right? At the moment.
At the moment, it's past order books which are getting completed.
Okay.
But as of now, nothing new.
Okay. So I went through your numbers. 86% would be from steel industry.
Correct.
8% would be from power.
Correct.
Or power, right?
Power.
Yes.
So steel plant equipment is something which we're really focusing on and very bullish with. The steel industry should be growing at about 10% every year going forward, which should add about 100 million tons in the next 10 years. Each million ton cost to set up is a minimum of 4,000 crores.
Sorry, how many million tons are you going to project?
So currently, I believe India is at about 130 million tons.
Okay.
And the target is 230 in the next 10 years.
Okay, 100 million tons in next 30
And
years. Okay.
each million ton to set up is going to cost about 4,000 crores in Capex.
Okay.
So there's a very large investment coming in this space.
Okay.
And currently...
So there is 4 lakh crores.
Exactly.
Okay. Investment that's coming in. And what in that, let's very plain percentage terms, what would be the for you, meaning for the equipments that goes into this percentage?
Maybe about 50%, if not more.
50%. Okay. So let's say 2 lakh crore rupees that's into this.
Exactly. So we've re-entered into this industry in the last few years with another part of our promoter group companies, Lloyds Metals.
Okay.
They're going through an expansion phase as well. And we are building a lot of equipments for them in the steel plant industry, whether it's kilns for their sponge iron units or other things. We work with them on a competitive basis. So they put a tender out, and if we win the tender, we get it. If we don't win the tender, we don't get it.
Okay.
But we do work on a profit basis. So we do still focus on our margins while winning the tender on a competitive basis.
Okay.
So
how much do you expect margins to remain?
So north of 15%.
North of 15%. Okay.
And this is an industry which we feel will significantly grow. So a few years ago, it was almost zero. This year, we should be at about 400 plus crores, if not more. And that's within this as well as the power plant industry, because in power plants, we focus on boilers. a large part of boilers are through the steel industry.
Got it.
Because the steel industry produces a lot of waste heat. And the boilers that we do are WHRB, which is a waste heat recovery boiler. And currently, our boiler division as well has seen significant growth. Again, a few years ago, we were zero. We invested in the teams. We got senior people. We got some senior designers, senior engineers, focused on new equipment. We've got a lot of welding and automated welding equipment for the boiler industry to give us a good output. And we've got 8 different clients in the last year alone. And there are some top names from the steel industry within that. And it's a good way for us to go forward. And we see a lot of potential within this field as well.
No, let's stick to the steel industry for a minute then. Steel industry, despite you say this growth story and things, China's exports of steel is at an 8-year high because their construction industry, where they rely 33% of the GDP or 35% is on a slump there for a long time. And most of the steel is coming to India itself. And these are produced with electric arc furnaces, low CO2 emissions. Are you seeing any challenges in this industry, in this area? And secondly, even if you're seeing challenges, what is your raw material? It is steel. You're catering to the steel industry, and your raw material to make
steel.
these capital goods is steel. So how is like the overall equation setting in?
So for us, China exporting to India is not really much of a challenge. Like you said, our main raw material is steel, and we work on a competitive basis. So whoever offers us the cheapest material, we buy it from them. And the steel industry in India is expanding and does require a lot of heavy equipments, whether it's a blast furnace or whether it's boilers or whether it's kilns or whether it's process equipments or other things. So that's where we are focusing, and that's where we're giving our expertise. Within building our teams, we're also focusing on creating at-site teams and focusing on equipments that we can manufacture and deliver at site rather than using our facilities. So while our facilities might grow at 2x, the steel plant division might grow at 10x. Because we're looking at giving equipments engineered by us, manufactured at site
near the plant.
And near the plant.
So steel industry is one of the great growth legs for you. And what is the other area that you're looking at? Power, nuclear, you said?
Power plants, which is boilers, which is also sort of linked to the steel industry, but that's again a new, we're restarting in that division.
You said this, all these numbers we've gathered together, had some rough calculations. But if you look historically, China, which grew from the year 2000 to 2010 at around 10.1% GDP growth, their construction industry grew by 22%, while their steel industry grew by around 16 to 18%. I cannot get the exact figure, 16 to 18%. So is that the kind of growth we're going to be seeing again?
Yeah.
That is history. So when we speak to a company, we say, okay, boss, your GDP is growing at 8%. Now, what will be your industry growth? We spoke to someone in glass, architectural glass that goes into buildings, facades, and they're saying 22%, 25% industry like will grow. Automobile, they're giving us a good 14, 15% figure. So in your capital goods, how much would be the growth?
We should expect a 15% as a bare minimum. And because we're focusing on multiple industries, not only steel, not only hydrocarbon, not only X, Y, or Z, we're focusing on a lot of different industries. For us personally, we should definitely see a much larger growth than that. Along with that, we're looking at onboarding a lot of new technologies and collaborating with many different companies around the world to get exclusive rights for India, whether to manufacture those products or to create a very big niche in the country to give us good margins and to give us a good top line growth as well.
I can't, it's big deviation. I can't help but I have to ask. You are very young, and how is it that you came into the company, increased efficiency, you said the 4 pillars, etc. So what do you think? Because you're a second generation entrepreneur, all said and done, and then there is a misconception that it's very easy for the second generation or a third generation to build the business, but I think it's quite difficult because you have bigger shoes to fill. Like if you're a first generation entrepreneur, you can try all the tools that you have, you can fail several times, but then as a second generation, you have a lot of expectations on you. That is first item. Second item is, how do you see the young, you said the management changed. So how is it the young ethos helping the company, and what are the new benefits you're giving? So just to extend my area again, our company, Green Portfolio, our average age of our employees, we have around 30 employees, would be around 27, 26, 27. And our co-founders are like 34, 36, two co-founders. And as a young team, we're able to grow very well, customers satisfied, everything in place. So has it been the same for you, like a young team better, and this family filling into the shoes? How does it play out?
So it's been very challenging to set off or to start off with, because obviously my father started this company in big shoes to fill, and I wasn't involved in the engineering aspect or have an engineering background per se. But the first 2 years that I took to understand the company from top to down and understand the core issues with the company and set a very strong plan on how to mitigate those issues and how to grow from there, I think helped us. Once we changed the management and took over from the previous management, we were able to make a lot of changes. And I said people were a very strong focus for us, because based on my past experience, people can make or break a company.
Absolutely.
And growth can only come when you have the right people at each step. So we looked at getting a lot of good quality people at different steps, and motivation of those people and incentivizing those people, number one, to stick with the company growth, and number two, to stick around the company, because we felt attrition was a very big part. So how do we make sure people are motivated to grow within the company, have equal ownership to be aligned to growth rather than satisfied with what they are currently doing, and stick around for a long term, because I don't want somebody to come, work 2 years and go. There's no joy for that person or no joy for us. So we incentivize the people monetarily by creating a variable pay or by creating incentives which are linked to KPIs. So first we set out KPIs, set out SOPs, processes, what each team and each person is supposed to do. Once they achieve their own targets, what they set, they get incentives.
Okay.
Incentives and variable pay is very unique to this industry. It's more of a service and a retail-based concept, not very relevant in the manufacturing industry.
No.
So that really changed the cycle, where somebody could earn as little as 5% and as high as 30% of their CTC, depending on their performance. So
does
that
it include ESOPs as well? Because youngsters do prefer ownership.
Correct. So that's the second part of it.
Okay.
We also initiated ESOPs, which are in employee stock options, which is again very unheard of and very unique in this industry. And this is the first year when, from March 31st, 2024 is when it's going to start getting vested.
Okay.
And we're giving it to a very wide range of employees. And what we've seen as a calculation is that anybody who has earned the ESOPs gets a minimum of 50% of their CTC every year. And it goes up to 150% of CTC for this year alone. As the performance increases, as the performance improves, top line, bottom line improves, everyone is incentivized to reaching the targets and to growing as much as possible. So if people are working as if it's their own company, because at the end of the day, they do have ownership within the company.
Yes.
The company is bound to grow. And as it grows, hopefully the share price will grow as well. As that grows, their net take home of their ESOPs will grow.
Direct benefit.
So that has been a very core fundamental which has helped the people and the team to work towards a common goal and not
just
work for the sake of it.
Okay. Because you're listed compared to, like, let's say, a startup that's giving ESOPs, they can evaluate the benefit directly. That'll come to them in 3 years or whatever
Exactly.
vesting period may be. Anyway, and now coming back to the business part of it, you are saying that you recently mentioned that 2x capacity here and 10x capacity when it comes to steel. So how do you plan to fund the Capex? Because your current operating cash flow is negative. Even if you're getting revenues, you're building up inventories. Okay. First, I want to ask, why are you building up inventory so much so that the operating cash flow is negative? And if your operating cash flow is negative, how are you able to invest into Capex? And anyways, you have to invest into Capex because you're growing, right?
Correct. So our inventories are growing as per our top line and the growth that we see. In order to improve efficiencies and to reduce delays and issues in our manufacturing stages, it's growing as per a regular percentage of our top line growth. And our Capex investments, we're not looking at adding debt. We're not looking at adding debt. So, because that's a core belief for the group that we don't want to add debt in any way.
Okay.
And we're going to continue debt free. So we've done a rights issue recently where we've generated some funds, and that will be used for current and future Capex growth.
Okay. And if you're not going through debt, or this, like you said, your inventories are building up to support further growth, then can investors, if someone is investing, can they expect further equity dilution?
No, not at this stage.
Okay.
We're happy with the funds that we have, and we're happy with and we have a good vision for the future to continue at this stage. And along with this, I just wanted to also add on a few key technologies and collaborations.
Yes, that was my next question. So in your presentation, you mentioned that you are into 2 technological collaborations, and it's a very fancy term. Everyone is using tech, AI, and getting valuations. So what is it that you are doing in this tech? Okay. And explain the impact on the business.
So definitely. So one major thing on technology advancements in the manufacturing phase is that we're looking at improving our equipments that do the work, looking at improving our capabilities in automation of welding, getting robotics and automation combined along with AI to help us to improve efficiencies, reduce costs, get more output at a shorter time.
Okay.
That will help us to improve quality, improve speed, and definitely give our customers more comfort that we can do the job at a faster pace.
Got it.
Second, on technology collaborations, we've collaborated with with an American company that has developed a proprietary technology for pickling of steel.
Pickling of steel.
Pickling of steel. So just to give a little background, about 40% of the steel manufactured is cold rolled steel.
In the world?
In the world in general. And all cold rolled steel has to be pickled as a process so that it can have a better life of its product. Pickling done in the entire world has only been done with acid. So acid pickling is the standard in the industry. And acid is bad for obvious reasons in terms of corrosion and various other environmental issues. In India, usually acid is done or pickling is done by having an acid processing unit or an acid recovery unit. Many people don't use an acid recovery unit because it's expensive, which is technically illegal, but it's still done. So this technology that we've collaborated with does pickling of steel without acid. So essentially it's a green pickling of steel, which is done using steel grit, which is a scrap of steel or which can be used as scrap for steel manufacturing as well. So it's a zero discharge, zero pollution alternative to pickling of steel. All of this while being cheaper. A regular pickling line might take 150 to 200 meters of space. This would take 50. So it reduces the investment drastically, as well as reducing operational costs. So it is a win-win for everyone, for the steel manufacturer, for the steel producer, for the end customer, and for us as well. So we have the rights, exclusive rights for India for this technology.
Okay.
So we will be developing this and selling this to a manufacturer or a processing unit who does processing of steel.
Got it.
And this will help us to increase our top line without using our manufacturing facilities as a whole. So some of the equipments are bought out equipments. A major part is technology and design and engineering rather than manufacturing.
Got it. Got it. So you're basically saying this is a benefit to the steel manufacturer, okay, and you, and because thirdly, it requires much lesser space. And fourth point is that you are able to do this in the same manufacturing facility, hence you do not require any capex.
Correct.
Right.
Correct. And the average pickling line can go from 80 to 250 crores.
Okay. For your cost, or okay, you can't disclose cost right here.
A manufacturer would spend 200 or 80 to 250 crores to set up a pickling line depending on the capacity.
Okay.
Eco-pickled steel line would be 15 to 20% cheaper than that at the bare minimum.
Got it.
All of that while keeping our margins.
Okay. The same margins, or would margins improve?
Since it's a technology and since we are having the exclusive rights for India, our margins would be considerably higher.
Okay. Okay. Great. And you, before we had this discussion, you had mentioned that in US, these many pickling plants are there, facilities are there.
So the company's developed this technology over many years, and its final iteration is the fourth generation. Final iteration is the fourth generation, and they have about 50 units in China. Plus, they have multiple units in North and South America as well. So it's already a tried and tested, used by multiple end product users. So the quality is already guaranteed. And yeah.
Okay. So this should improve margins, and they're giving you exclusive, right? But is there any European or Japanese company who has the same technology that can give this technology know-how to another Indian company?
As far as we're aware, there is no other company in the world who's doing this type of technology, and it will increase. But at this stage, this is the only company, and we will be the only ones in India offering it.
Quick question: pickling plant in US, it's how many? You had mentioned this.
I believe they have over 15 of the eco-pickled processing units in North and South America.
Got it. And in China?
About 50.
50. And because its environment norms are more stringent, right?
Correct.
India is 0.
India is 0. They tried to come in, but nobody saw the benefit in the past.
Okay.
We were researching this technology, and we thought that it's a great potential. And we were very prompt and efficient, and within 6 months, we signed the agreement with them.
Okay. Great. And I wanted to ask you about exports. Quick question on exports. Anub Engineering, ISJEC, and even Thermax, they have export contribution. Anub Engineering, I believe, is 25%. ISJEC around 13%. You don't export. You export to 0. Why is that? Or do you expect exports to?
So the management philosophy earlier was not aligned towards that.
Okay.
Currently, we're rebuilding, or we have rebuilt our entire team at HO as well as factory. We are improving our quality of facilities at our factory and adding more equipment and processes. All of this is in line with export standards and export requirements. So once we complete our Capex and once we complete our rebuilding phase, we will definitely target export and be extremely competitive in the same field.
Okay. This is a last casual question. We'll end this. Why don't you do con calls? Because we were trying to find information on the company and it's very difficult. So why don't you do con calls?
This is the first one that we're doing, and I think we will be doing many more after this. And we wanted to get our core foundation right.
Absolutely.
We wanted to get our actual numbers out there, let people see what the company is and how we've grown. 2 years is better than 1 year in terms of
numbers don't
run
lie.
rate.
Numbers don't
exactly. And we wanted to have a consistent run rate, not just a one-off. So we do have a consistent run rate and a good scope for the future. So now we have something more to talk about.
Awesome, great. It was a great discussion with
Yes.
you. And I learned a lot. And we look forward to airing this interview
Thank you very
soon.
much.
Thank you very much, Krishna.
Thank you very much.
Thank you. Look, business is one area of it, but
Correct.
financials is the most important.
Most important
we look
thing.
at. And you're the CFO.
Correct.
Okay. So I wanted to ask you, there are three companies. Lloyd Enterprise, which you say is the holding company.
Yeah.
And then again, name was changed. Then Lloyds Engineering Works. Then there is Lloyd Metal. So how are these companies connected, and was it later split up?
No, there is no such connection between these three, except that Lloyd Enterprises is a holding company of Lloyd Engineering. Lloyd Metals is having a promoter. One of them is Lloyd Enterprises.
Okay.
So in this way, the chairman of Lloyd Metals and the chairman of Lloyd Engineering is same. That is Mr. Mukesh Gupta. And as far as our division, which we, our business, what would say, the engineering business, basically it started in 1974. Till 1990, our promoters were interested with this business only. And in somewhere in 1990, they thought about a steel business in the same company, Lloyds Steel Industries Limited. So somewhere in 95, the steel business was, Varda unit was being manufactured, means what to say, started. Till 2012, the Lloyds Steel was having two businesses. One is engineering business and one is the steel business. But steel business post 2000, 2001, there was a huge downfall in the business.
Okay.
And that's how a lot of debt was there in that business.
Is the engineering business or the metals business?
No, it's a steel business.
Steel business, sorry.
Metal was, metal was having a mine.
Okay.
That's a iron ore mine situated at Gadchiroli. This got allocated somewhere in 1997. But being at the Naxal location, it was very difficult to extract the mine. So just I would want to brief on first of all on our business. So 2012 there was a management change and we sold out the company, a management change through additional insertion of the equity. 2012 management change happened and steel business and engineering business got to the new management. And there was a demerger from that company and engineering business was taken back in this company, which is Lloyds Engineering Business now, known as Lloyds Engineering Works Limited. Prior name was Lloyds Steels Industries Limited.
Got it.
And since 2014, this engineering business came into this company.
Got it.
And till 2020, that the earlier, the new management which took over went into NCLT. That was the reason why there was no such big opportunities or big business being taken up in this business. And when the things got cleared in December 2020, our promoters took over the management in May 21, and that's how what we see as of now, their growth path. That's why there was fresh equity of warrants, then OFCDs, and then finally a right issue.
Okay. Now I want to focus on these areas.
Yeah.
Your other current liabilities are very high at 150 crores. What exactly is that?
Means this was at a given point of time on 30th September.
Yeah.
But this was mainly due to the advances which we received from our customers.
Okay.
And a lot of deliverables were there.
Okay.
And as of March, you would see a very drastic change and it would be a very minimum only. There was a particular point of time only. That was the reason why that was.
Because we're looking at the balance sheet and there are certain spikes from 0 to 100, for example.
Correct.
So, for example, right to use assets.
Right.
It's gone from 0 to 14.1
Yeah, basically, this is due to the, we have relocated. So, we have taken on lease the offices.
Okay.
As well as we have taken a lot of plant and machineries on lease basis.
Okay.
So, these are the two reasons why, according to India's 116, we have to take it on a balance sheet as a right to use.
Correct.
That's the reason why it is so. And there is no future plans to increase this right to use. That's it. It would go on a steady basis only.
Okay. Now look, one biggest issue for equity holders would be the dilution. Since last 10 years, you would have diluted a lot of shares because the optionally convertible debentures were one.
Yeah.
Then rights issue.
Right issue is not a dilution because these are given to the existing shareholders only. So it actually doesn't go for dilution unless the
They have to bring up with more capital, no, on the table. They
they have to bring up the more capital, but if existing shareholders takes the right, then there is no dilution as such unless they want to renounce it.
True. I get it. All right. I just had these minor areas. Any other financial parameters am I missing from this? EBITDA margins?
EBITDA margins are around 16 to 18%.
16 to 18%.
And we would be growing forward also, we would be maintaining that in whatever case, because we are taking utmost care while bidding so that our margins are secured to that extent.
Okay. Any forward guidance do you give, or do you refrain from that? Forward guidance, anything?
No.
Okay, no forward guidance. Okay. So 15% plus
of
would
course,
be your
of course.
EBITDA margins.
Correct.
If any project is coming below that, you won't participate.
Unless it gives a long-term vision for that.
Okay.
To enter the industry, then definitely we might look at it.
Like the shipbuilding that he had.
Shipbuilding wise, defense in the defense sector, normally margins are good compared to the other industry. But as we are a new entrant in that, so we might initially go for it, but margins would definitely not be going beyond it.
Okay.
And after that, the best part is the spares business, which comes once you manufacture a ship or a part of the ship, then the spares related to that, or over the period of 20 to 30 years, comes to the same person who has installed that.
Aircrafts.
Like aircraft, like Navy also in that. Steering is where we are focusing more on stabilizers. For that, first point of inquiry comes to us only. So there is where the business is.
Got it. Now, look, cash flow is king,
Right.
but your cash flow is negative.
The reason being we are at a growth path.
Growth path.
The growth path, whenever you go at a CAGR of around, in terms of revenue, 30 to 40, definitely initial stages, the operating cycles are on negative side. And once it stabilizes, then your operating cash flows our profitabilities are increasing, but mainly it is working capital.
Is inventories, right?
Inventories main primarily, and then customers also.
In the future also, are you going to build up inventory like this that your operating cash will be negative?
No.
Or do you
After a certain point of time, the rollover will start.
Okay.
And then inventory would be maintained at the same pace, and the profitability would increase. That's how the operating cash flows would be maintained in a positive way.
Got it. Excellent. Great. I think these were the questions.
Thanks for it.
Thank you so much.
Thank you.